Yeah.
But hold on, let's test it. Sorry if you guys are listening to this, a recording of this. We're just trying this out for the first time. Let's see if it's actually like it's actually working. Now live on your channel, Inflation and Monetary Policy. Great. It looks like it's working.
All right.
Cool. Welcome back to the podcast, guys. And I would say, first of all, I think maybe we owe a little bit of explanation of what happened.
Yep.
Maybe Hari, you can go first. I'll toss the top potato over to you.
Yeah. Well, I've been in prison for the last 6 months, so but insider trading they can actually arrest you for that. I found out the hard way. So seriously, we've just been, Becco and I both have full-time jobs, and he's got a startup. I've got a startup that's now in year 7 or 8, and we were just busy, and we don't no longer live together. And well, we never lived together, but we were in the same city for the first several years of the podcast. So this is the first time that we it's just hard to sync up schedules. But hopefully with this live stream setup, we'll actually be able to just hit the live button and just record and present all the same stuff that we were always doing. So
yeah, I'll just add to that. I know there has been a lot of communication to our emails saying, where the hell are you guys? So I really appreciate everybody that reached out and is continuing to enjoy the podcast. So thank you, first of all. And then secondly, just want to talk about what Hari said. Both of us, it's interesting because we're talking about value investing, which is kind of the old, but perhaps outdated, some might say it's outdated discipline of investing, where, it's sort of like looking backward. And then we work in sort of the technology frontier. We run our own startups, and so we live this interesting. It's an interesting combination of tech startup entrepreneurship, and then we also have this interest in value investing. Anyway, long story short, we've been super busy with growing our own startup, and it's just been really busy to make time. But with this new setup, what we hope to do from here on out is, instead of having, one of the problems was, one of the issues with us was that, like Hari said, we don't live together, and it's just difficult to coordinate time. And for us to find time out of our schedule, it just became really a big burden. And on top of that, we have to do a bunch of editing, and that just took a lot of energy out of us. So instead of all that, let's say, fuck all that. Let's just hit record and talk about what's on our mind. And then, when we do our analysis, we'll just do it live. And, we'll spend some time, obviously, preparing. We'll do it live, answer any questions you guys might have. I think this is just a better way for us to get it going. And also, I think it's a better engagement, where if you want to actually jump on to live stream and ask any questions, I think that would be a much more engaging medium. So excited to be back. I'm excited to be back, and there's so much to talk about. And so, yeah, that's just a quick summary.
Yeah, and before we get into the topic today, all of the same avenues that you have to reach out to us, the email info@valueinvestor.org is still active, and we still read it. And if you want to get on our Slack channel so that you can ask us questions, please take advantage of that, info@valueinvestor.org. And what will also really help us is to boost our engagement, make the YouTube algorithm give us more, is to subscribe and hit the notification bell. And if you can comment either on the chat when we're live or afterwards, that would really help us, because that's how YouTube kind of promotes our content. And then I think we've got a lot of stuff we'll be announcing over the next few weeks in terms of exciting things that we're doing to help get everyone back on the education. Our goal with this podcast has always been to educate people, and we want to continue to do that because it's beneficial for us. to talk about it, to engage with people, to have our ideas challenged. But I think the other thing that would really, kind of keep this podcast on track every week is getting some monetization out of it, because uh, for us to, to do this on our own time, as Becco talked about, if we're so busy, but if there's, if we're getting paid to do it, then it's a different story, right? And that means that we'll show up every week, and so we're trying to get there. We've talked about that in the past, but haven't, pushed it forward. But I think this time we're going to make a concerted effort to get there, so that you guys can actually engage with us and get more out of this entire thing. And that means that we may, start talking about, some various ways that you can help pay for certain things, either through, paid content or otherwise. So
yeah, we'll talk more about that once we have a little bit more detail on that. But should we just get started? Should we get started on these interesting macro topics?
Yeah, absolutely.
Where should we go first? I think we should talk about inflation.
Well, I mean, I think it's probably the number one topic on everybody's mind right now. And I don't know that of any country in the world right now that isn't experiencing, some sort of inflation from the last 2 years of, free spending. So it's a really important thing, because it essentially destroys your, any money that you save in your bank account is going to get wiped out by because it has less purchasing power. So I'll ask you, Becco, like, how are you seeing that affecting, some of the companies that you're following?
Let's see. Obviously, the stock market has completely shit the bed in the last couple of weeks and months. That's not surprising. I think. Let's see. How should we talk about this? I guess the inflation. It may be helpful to talk about why is this happening.
Okay.
To start, right. I mean, I think at this point, if you are following the financial market, you're probably aware of what's going on. But I think it's important to talk about why this is happening, and perhaps we can start with the pandemic, right? So pandemic hit, and then what happened? The world shut down, and then and perhaps this even goes back beyond, before pandemic. A lot of the oil and sort of investment that was not made over the last 10 years in energy, for example, that started to bite us when it comes to gas prices. Obviously, the Ukraine war definitely made it worse. And then, so there's the supply side issue, the actual commodity that's being produced, and the supply chain issue that's being throttled. That's providing, cost. That's a bottleneck right there. And then the other side is the money supply that's been inflated because of pandemic. A ton of spending from the government, easy monetary policy, that added to the fire. And so all of that combined just led to this incredible surge in inflation across the world. And it's having an impact on our lives now, right? It's when you go to buy, for example, for me, if I look at my spending, what do I spend my money on? I spend my money on food. That's the first thing that comes to my mind. It's definitely gone up. I don't know if you've noticed in Houston, but it's certainly, whenever I go to, this one time I went to a pizza restaurant, and then we ordered 2 pies, and it came to be $60, $70.
Yeah. I think one thing that you hit on that's really important is that, when oil and gas goes up, oil and gas is an input into almost any product, right? Any physical product has to be shipped, or delivered somewhere. And so you've got to spend money on that. And when that doubles, there was some buffer that was put in there because there was long-term price contracts on, your airlines and your, trucking companies will pay gas on a contract for 3 months. Eventually that contract expires, and then the price goes up. And when that happens, suddenly there's a big price shock. And then, so now your food is more expensive. When you go get your toiletries, or, from Target or whatever, right, they have to pay more to get it in the store. So it's not that the input good is necessarily gone more expensive, but the the raw materials may be the same price, but getting it to the store has become so much more expensive. And then on top of that, you have a bunch of people who didn't travel, but still work from home or something like that. They saved all their money. Then the government paid them more money to sit at home, and do it. And then suddenly they have all this extra cash and they've been stuck in their house haven't seen family, haven't gone on vacation. And then they suddenly throw all their money into it. And you have the airline industry, which, couldn't rehire people fast enough. So they created disruptions there. And so the natural thing is the price goes up because they can't hit all the demand. So the airline industries raise their prices to keep up with, um, they have dwindling supply and high demand, so that the only thing that they can naturally do is raise the prices, right? So, um, when all of this comes together, right, you look at very poor pandemic policy, like government policy around the last administration, the Trump administration, and this one, where both administrations signed, very large bills, that put trillions of dollars into the economy, and a lot of that money went to, PPP, loans and things like that. But in the last year under the Biden administration, they put $1.9 trillion in, and a lot of that money went to state and local governments. And so state and local governments, essentially took that money and, spent it on a lot of stuff that, frankly, I think was causing a lot more, was causing a lot of this inflation, right? Like, we'd already pushed a lot of money into the economy, and then we did a huge secondary amount. So, I think the biggest thing I've seen with this is that you've changed the input prices for one of the most critical, things, which is oil and gas. The Russia stuff didn't help it at all, but it wasn't the source of the problem. The problem had already started, down the path, and now we're in a situation where we have, very expensive oil and gas, which, the administration is doing very little to actually alleviate that. And so I don't see it letting up for a long time. I think $4 to $5 gallons of gas is going to be here for a while. Looks like we may have lost Becco's audio.
You hear me?
Yeah, now you're back.
Okay.
Sorry. Go ahead.
So yeah, sorry about that. So it's so multifaceted. I think we need to kind of quickly summarize, right? There's the money supply that was printed, right? Easy monetary policy that was, increasing the money supply that eventually led to the inflation. That's one aspect of it. Another aspect of it is all of the supply chain issue that was sort of shut down, and then pent up demand. That's another thing. And then within the and perhaps if you double click on the supply chain, there's the raw goods that go into that, and obviously a critical part of the input into any manufacturing is oil and gas, and that's kind of the point that you're making about the oil and gas and the Russia invasion of Ukraine. That obviously didn't help. We can spend a whole podcast on talking about this interesting geopolitics around Russia and what that means for oil and gas prices. But I think that not sufficiently, but I think it kind of covers the just the rough background about inflation picture. I think here now let's now talk about the solution. What's the solution, and what is, we talk about interest rate, the whole financial market. By the way, I think the thing that's so interesting about last couple of years, last 3, 4, even 5, 6 years, is that macro theme dominates all financial conversation. It dominates market conversation, and we can get into that some other time. But it touches everything, because it's just so pervasive. Anyway, we don't have to go there, but let's talk about the interest rate, because that's one of the ways that the government is trying to combat this at the moment.
Yeah, and I think because I think this topic may be a little confusing or complicated. So I'll try and summarize what interest rates are doing. Typically banks loan out money to buy a house. You borrow money from the bank at a certain interest rate. Well, the bank can actually borrow money from the uh, federal government uh, at a certain rate that is controlled by the Federal Reserve. And so when they talk about the interest rate, what they're actually talking about is the federal overnight borrowing rate for the banks, and they set that rate. And in Europe, that rate was actually a negative number, right? For several years, it's been a negative number, and they finally just increased it to a 0%. In the U.S., it's always been above 0%, but it's been very low. And they took the first step was, or the last interest rate rise was actually 3/4 of a percentage point. So imagine if you're that translates into a mortgage rate that was at the beginning of the or middle of the pandemic was like 2.5%. Now that interest rate is like 5.75%. So that difference is actually enormous amount of money per month, in terms of how much you have to pay. You're paying a 5% of the entire principal is essentially being paid out in interest every year. So if you paid, under a 2.5% interest rate and you had $100,000 home, you're paying, around $2,500. But now that number is, 5,500. And many of these things mean that a house that you purchased, previously purchased, becomes unaffordable, right? But it's the same thing for you know for that you apply to a mortgage. It applies to businesses who are borrowing money to start a new restaurant or get startup capital from a bank. They're spending that money to do the same thing. And
Hold on,
the
Harry. I think the important fact to highlight here is that the group of I heard it somewhere that it was talked about like this: a group of elders come together and decide the value of money every 6 weeks or so. That's basically what this federal funds rate interest rate is. And I
right.
think what you're trying to say, I think the important part here is that number that the group of elders come and decide has ripple effect everywhere,
Yep.
everywhere, everywhere.
Yep.
So when they increase the interest rate, they're talking about 75 basis points. It's like that has ripple effect everywhere, including to you, to me, every businesses, everything.
Yeah,
Uh,
and it's
yeah,
a crazy concept, really. When you break it down, it's a crazy idea that they are essentially changing the value of your house overnight, right? Because something that you could afford before, now you may not be able to afford that house if you refinanced your mortgage or what have you, right? They're literally changing the value of your house by increasing the interest rate. And for the last 10 years, that number has been historically low. And the current interest rate of 5.75%, we have never had interest rates below 5.75% except in the last 10 years. So this is like an unprecedentedly low value. And so now the reason they're doing all of this is they want people to stop investing into the economy because there's already too much money. So if they increase the value of stuff, people will, or I'm sorry, decrease the value of stuff, they'll stop investing and take that money and put it into savings instead, because they can get a higher interest rate from a bond, or they can get a higher rate of return from a bond. Um,
yeah.
so I don't know if that was confusing to a lot of people, but
All right. By
the
the way, I'm
yeah,
hearing a lot of static noise from you. Maybe it's from me. I don't know. There's like
let's see. Is that any better?
let's see. Yeah, maybe better. What did you do? Just switch out the audio. No, it's not better actually. Still hearing it.
Okay. What about now?
Yeah, maybe better. Let's see. Okay. Okay. Back to the topic. So, like this federal funds rate has massive implications across the entire economy. And what's interesting about that is that the federal funds rate is controlled by Federal Reserve in the U.S. and there's all these central banks around the world that controls something like that in their respective countries, and it has implications all across the globe. What's interesting about what's happening today in the backdrop of this crazy inflation is that everyone is raising interest rate, and people talk about demand destruction. I've never actually heard that term before until recently. Demand destruction sounds so kind of apocalyptic, but basically what's happening is what you're talking about, right? It's like when you raise interest rate, what happens? Borrowing cost goes up. If the borrowing cost goes up, then you're more hesitant to buy that house, or you're more hesitant to buy that car, and so your demand of the greater economy or the greater market is going down. Therefore, you're sort of like tampering the demand, which puts downward pressure on the price, which in return it combats inflation. And so that's kind of what's happening. Where should we go from here? So I think we talked about inflation, we talked about interest rate.
Well, I think what we can do is kind of talk about inflation and interest rates and how that impacts individual companies, right? Not talking about a specific company, but just saying, as a business owner, what does that actually mean, right? And I think that's an important thing, because that's what we're ultimately here for, is buying, stocks, which have gotten hammered over the last 2 to 3 months. So, I guess I'll start with this and ask you this question and see if, if you've been looking at companies, recently. Well, actually, before I get into that, I'm just going to put in one more thing that's I think is very interesting about this entire process, right? Is that normally during the beginnings of a recession, we start seeing layoffs. And what is really interesting about this is that coming off of the pandemic, we're actually still seeing very low unemployment rates. And I've it's been a head scratcher for me for a while, until I kind of looked at some other data. And one of the things that's interesting about this is that there are a lot of people during the pandemic who've actually left the labor force altogether. So they found, they got laid off, or they decided to stay at home and not come back to the job market. And so now you're seeing a lot of businesses trying to hire people, but can't, because they don't have, they're the workers are just already in a job. So, I mean, do you have any thoughts on that, Becco? Because to me, that's kind of and maybe it's going to happen in the next few months, right? But currently, we're still seeing very low unemployment rates.
That's right. Yeah. So that is a big head scratcher for me too, which is like, why is it? I guess the question is why. What is going on? But what's also interesting is that we've heard from, at least from like tech industry, and I think this is the case across the board, is that everybody is putting hiring freeze. Everybody has laid off already, and it's probably more coming. But I guess it is happening, right? So like this dampening of the economic activity is starting to take place. Now the question is, like, why is it so elevated to begin with? Is that your question?
Well, I mean, I look at it as, with the economy being hot, right? That is kind of what, part of getting out of that kind of hot streak is kind of when people start sensing that they're going to lose their job, or there's a potential for losing their job, they stop spending, right? They try and retain as much savings as possible, and to kind of put up a buffer between them and unemployment, right? And like you said, now tech companies are doing, hiring freezes, or they're not necessarily laying off people, but they're hiring freezes. And we already are 1 quarter of negative GDP growth. Um, we're in the middle of we've just completed the second quarter, but I think we'll find out in the next few weeks if Q2 also had a negative thing, which I think it's pretty likely. But so I guess, when do we start seeing layoffs, right? Is that going to accelerate, or are we just kind of have a mild recession here? The economy will cool off as the inflation gets slows down. That's kind of the effect. Like, are we going to see more dips in the stock prices, or are we going to see, is really what I'm getting to.
I feel my informed speculation. This is obviously just speculation at the end of the day. It feels like there's more to go because because again, like, it's kind of funny because the whole financial market and the whole like Main Street, Wall Street, both, everybody is talking about interest rate hikes. Whether you're like mom and pop shops, selling pizzas or whatever, or your Google, everybody's talking about interest rates because that just dictates everything. And I
Yeah.
feel that, it's because this is like so important right now when the federal government is trying to fight inflation and they have so much sway over the economy. They're trying to like really tamp down the inflation. I think they lost a lot of credibility, frankly, in the last couple of months, and I think they're trying to regain that. So for them, in my opinion, psychologically, I think it's very difficult for them to say, maybe we'll pause on the interest rate hikes. I think it's very difficult for them to do that at the moment. I think they'll do whatever they can to smash this inflation down to the ground, which means that more demand destruction, like we talked about, which translates into more layoffs and foreclosures, and housing market is going to get touched. I think that's coming. That's my thinking. I think it's coming. I think part of it is just Federal Reserve trying to maintain their reputation that's been tarnished over the last couple of months. That's my sense.
I mean, I think you're right. A lot of people have. I mean, there were a lot of people who didn't ever really have faith in it, in the federal government and the Fed especially. But I think they miscalculated. They didn't think that inflation was going to be really all that bad, and I think they had an opportunity early on to raise the interest rate much faster and kind of slow things down much quicker, and instead just kind of said, oh, it's not going to be so bad. Or, I mean, I think they even said, we didn't anticipate there was going to be any inflation, right? And it's like, well, everybody said that. I mean, you and I have said that since, early on in the pandemic, right? When we started seeing these bills. I mean, it's not like we don't know anything more than these people. I mean, I would hope that they actually know more than we do. But, when you pour more money into the economy, the natural thing is going to be inflation, right? And I think that's what we saw. And I'm frankly, I think it what it should mean is that, as Americans, or as any citizen that has a Federal Reserve type banking system, we should be highly skeptical of their ability to actually protect against events like this, because they're political animals more so than anything, right? And I think they didn't want to raise interest rates because it would look bad for the administration, and I think that's why you're seeing this.
Yeah. I mean, I think we could get into like philosophical discussion about what this means, but it just feels very old. It feels kind of like a very old system. You have these group of elders that come together to decide the value of money every 6 weeks. Well, the economy is changing so fast. How are they going to be able to do that, effectively? I think that's a big question for me. I think another question for me is like, okay, like, we're freedom loving, maybe this gets into kind of the philosophical angle a bit, but like, the road to serfdom, I suppose, it's the tyranny of the government. We could talk about sort of that, but like, it's, like, top down controlled systems are kind of inherently are fragile, are kind of inherently fragile because being able to kind of pivot and adapt very quickly. People talk about anti-fragile and fragile, fragility and anti-fragility. What's his name? Taleb. When you have a top-down controlled system where the feedback loop is very slow, it leads to a very fragile system. It can break very easily. Whereas if it's more nimble, it can course correct. That's an anti-fragile system that can learn from itself and improve over time. Right now, it just doesn't feel like the system is in place to iteratively learn and actually grow. So I don't know. That's just kind of my thinking on this. Yeah.
Yeah, I mean, I think you're right. Right, it is a system that we set market rates for almost everything in a capitalist society, and this is something that's set by fiat instead of like by any market driven forces. And so yeah, I agree with you. Like it's a problem. So
Yeah.
but let's we're probably going to wrap it up here in the next few minutes. So why don't we look at just talk about it? What do you see is going to happen in the next 6 to 12 months for companies? I think, right? Do we think we're going to see more earnings problems because of this? What about debt for companies now that they may have to?
Yeah.
They won't be able to take on debt at favorable interest rates. What are your thoughts there?
Well, I'll speak. Maybe I think perhaps this is interesting discussion here because we're both operators of a company, of companies. Obviously, you're much further ahead than I am. But I think if I put my entrepreneurship hat on, like an operator hat on, and look at this environment, I think it's going to be very tough. I think both of us are in the healthcare sort of healthcare adjacent space, so we're not going to be impacted so much by this. But I look at this macro environment and think, man, like it's going to be very difficult to raise money. It's going to be very difficult to access capital. If you are trying to access capital through debt market, you have to think about the interest rate. Clearly, I would say like the big cap companies in the stock market, I think there's going to be some, I think we're going to get like earnings recession. People talk about how earnings is going to get hit this quarter, next quarter, and so what you're going to see is PE compression in the market. That's what I think. So the multiples are going to get squeezed even more. Some people are thinking beyond this. This is like so perverted because everybody is playing this speculative game now because it's so manipulated by the Federal Reserve. Everybody, like even like value investing. Let's think about that. Like in the world where every financial or market discussion is dictated by interest rate, it's very difficult to very difficult to have like an honest conversation about like the performance of the company by itself in isolation because the macro picture impacts us so much. And so everybody now is like speculating what's going to happen. Interest rate's going to go up or down, and and so some people are speculating that Fed can't raise interest rate all that much, and they're going to have to pivot. And this pivot is going to come sometime in like the third quarter, fourth quarter, or maybe first quarter next year. And so like some people are thinking that maybe the bottom is in. I don't know. Like it's all speculation, in my opinion. But I mean, that's the world that we live in, and I think we have to be cognizant about that. I don't know. I just ramble off a bunch of stuff there. I don't know.
Well, I think I'll amplify one of the things that you said, which I think is really important, which is the PE compression. I think is going to be a big deal. There are a lot of companies that when I'm looking at just flipping through the Value Line investment survey, which is one of my ways to find deals, is a lot of companies had no growth, had no, going kind of sideways in terms of revenue for a long time, and they were getting multiples of PEs of 30. And if you looked at those same companies 10, 15 years ago, with interest rates roughly equivalent to what we have today, those PEs were like 15, right? And that 15 is still pretty high when you really get down to it, because you can get a private business for 6 to 8, a PE of 6 to 8. So you're still talking about a premium on the public market. But 30 is, that's essentially telling you it's going to take 30 years to pay back, your purchase price in earnings. And that's for a business that is not growing, right? I would hope to not pay more than 5 or 6 as a value investor, for something like that, and probably even less than that in a real, scenario. So I think that the inflationally, like the inflated valuations of these businesses is going to get hammered very quickly because of this. And I don't think what we're going to see is the valuation of a lot of these things is going to drop. We're going to probably see an earnings recession, but then the tech companies will come back up because they've gotten a PE, they've gotten a premium on their PE. But I don't think you're going to see that in a lot of other businesses that are kind of the also ran companies, like average return on capital businesses shouldn't deserve a high multiple. And I think that we'll start to see more of a normalization of that.
Yeah, it's interesting. I think the PE compression is going to happen. I think, potentially this could be a good opportunity to buy some of the companies that you always wanted to own. That is always be a good compounder of your capital. I think this could be an opportunity. I also, again, kind of not to divert the conversation too much into the macro picture, but like if the Federal Reserve decides to just like go back to the easy monetary policy again, my concern is that those like crazy high number nosebleed inflation or nosebleed valuation, they're going to come back. If their interest rates, gets down to what it was before, like it's gonna, like these crazy valuations, they're gonna come back. And speculative euphoric kind of betting is going to start taking place again, like we saw in the last couple of years. So now I think about that, I'm not sure how to grapple with that. It seems like a timing game, and it seems like it's very difficult to navigate. But certainly, I think in the very short term, I think the PE compression is going to happen, which could be a good opportunity for us to look at really good companies that's has good modes and all these things that we talk about. I think it could be a good opportunity.
Yeah, well, I think that's probably a good place for us to stop. We've gotten, I think we covered a lot of good topics here on inflation, the interest rate, the labor market, and then where do we see this? And I think we're going to have, as we get back on track here in terms of our recording of the podcast, we'll cover a lot more of these topics, I think, in depth, going forward. So, but I would say if you have any topics that are of interest, please comment on YouTube, ask us what you'd like us to cover next, or send us an email, info@valueinvestor.org, or ask us on the Slack channel. It would really help us out. If you can also comment and like and subscribe to the channel if you haven't already.
Yeah. Well, it's good to be back, Kari, and let's continue. And it's fun, This,
yeah.
And so I hope you guys enjoyed the show. Definitely leave a comment down below at the chat. Yeah, we'll looking forward to making more of these live stream. Sounds good. Thanks a lot, everybody.
All right, we'll see you all.